Let's talk about rubbery numbers. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. The RBA has published their credit aggregates for January 2018 today. Owner-occupied lending rose 0.6% or 8% over the past year to 1.14 trillion. Investment lending rose 0.2% or 3% over the past year to 587 billion. It comprises 34% of all housing lending. They changed the way they reported the data this month, and it changes the trend reporting significantly. We'll talk about that a bit later. Business investment fell 0.1% in the month, or 3.4% over the past year, to 908 billion, and personal credit rose 0.1%, but fell 0.9% over the past year to 151 billion. The monthly movements show that the mortgage sector is slowing. And there's a slide in business lending and a very small rise in personal credit. And much of the slack in terms of personal credit is taken up in the alternative lending sector, which we'll talk about in a separate post. But I want to look at the mortgage information in more detail. The smooth annual trends slow the slide in investment lending in January 2018. Now, if you compare this with last month equivalent data, when the RBA was running adjustments between investor and owner-occupied series, which they've now stopped doing, investment lending therefore dropped from 5% to 3% over the past year as a result of their changes. Talk about fluff in the numbers. Instead, they now report on net switching separately. After a spike in 2015, when the differential pricing started to appear, it's been running at about 1 billion each month. I did a mapping between the old and the new basis for investor and interest-only loans in the RBA credit aggregates. Since mid-2015, the bank has been writing back perceived loan reclassification, which pushed the investor loans higher and the owner-occupied loans lower. As they've now reversed this, so the flow of investment loans is lower and more in line with the data from APRA on the bank portfolios, and investor loans have suddenly dropped 2% lower, magically. But 2 points I want to make. First, I'm amazed that the bank feels it's okay to suddenly change the basis of their calculations when it's such a critical issue. The reason they've provided is perverse. Loan switching is normal. But suddenly backtracking over the past 2 years is just plain weird. The section in the stability report said it was going to happen, but that's about all. Second, it once again highlights the rubbery nature of the data on lending in Australia. What with data problems in the banks themselves and at the RBA, we really don't have a good chart and compass. It just happens to be the biggest threat in financial stability, but never mind. Now, the RBA says, quote, following the introduction of an interest rate differential between housing loans to investors and owner-occupiers in mid-2015, a number of borrowers changed the purpose of their existing loan. Adjustments for these switching flows have been applied to the growth figures over the period from mid to late 2015, when this switching was unusually large, but not thereafter, as the amount of switching each month subsequently decreased and remained relatively stable, and thus appears to reflect regular behaviour that occurs from month to month. All switching flows are reflected in the level of owner-occupied and investor credit outstanding. It's not a good look, is it? Now let's turn to the latest APRA monthly banking statistics for January 2018, because this tells an interesting tale too. Total loans from ADIs rose by 6.1 billion in the month, up 0.4%. Within that, loans for owner-occupiers rose 0.57%, up 5.96 billion to 1.05 trillion, while loans for investment purposes rose just 0.04% or 210 million, and 34% of loans are for investment purposes. So the rotation away from investment loans continues, and overall lending momentum is slowing just a little. But it still represents an annual growth rate of nearly 5%, still well above inflation or income, which is tracking at about 1.9%. Our trend tracker shows the movements quite well. Remember that August 2017 contained a large adjustment. Looking at the lender portfolios, we see some significant divergence in strategy. Westpac is still driving investment loans the hardest, while CBA and ANZ portfolios are falling in total value, with lower new acquisitions and switching. The Bank of Queensland and Macquarie are also lifting investment lending. In fact, we're seeing a pivot towards some of the smaller players. The market shares, however, are not moving that much overall, with CBA still the largest owner-occupied lender and Westpac the largest investment lender. Looking at investor portfolio movements for the past year, again, significant variations with some smaller players still well above the 10% speed limit, but the majors all well below, and indeed some in negative territory. So standing back, despite the static growth in investment lending, don't forget that overall debt is still rising faster than incomes by a factor of 2 or 3 times. Owner-occupied lending must be tamed too if we're ever to get back to a more even keel. And the case for more macroprudential intervention just got stronger. If you found this useful, do leave a comment, subscribe to receive future updates, and check back again next time. I'm Martin North, the Principal of Digital Finance Analytics. Many thanks for taking the time to watch.